Hi, this is Kevin Lynch from iVancouverNow coming to you again, and today we've got fantastic local mortgage broker Robert Mogensen.
Right.
I got it right?
All right.
I practiced so I didn't butcher this.
Good work.
Yeah. So today we're going to kind of talk about important topics about financing and how that relates to you if you're a buying or buying and selling and refinancing. We're going to talk about a handful of different things, and I'm going to kind of ask questions, and Robert's going to help us out get the right answers.
Right on. Absolutely.
Thank you for being here.
You're welcome. Thanks.
Awesome.
Thanks for having me.
For sure.
Yeah.
So, Robert, I'm a new buyer in the marketplace, and I'm just kind of starting. I'm browsing on the internet. I haven't even really started looking seriously yet because I don't know my numbers. What's the first thing that I should be doing?
The first thing that you should be doing, Kevin, is visiting somebody like me.
Okay.
I would say that that's probably the best place to go, and obviously I'm slightly biased as far as mortgage brokers are concerned versus going to your bank. But visit a mortgage broker, call a mortgage broker, and talk to him about what your plans are.
Okay.
And he can give you options and venues for financing that you probably won't otherwise hear if you go to the bank. Okay. So, and the reason I say that, if you're a first-time buyer and you haven't been through this before, if you're self-employed, for instance, very different situation than if you're a salaried employee, like a teacher or a fireman. So, so first call should be to the mortgage broker.
Yeah, well, that's a great point. Like one of the clients I was just meeting down here with the other day, they had connected with another agent a couple of months ago and never really got the ball rolling because they didn't get the financing structured, and it seemed like this guy was just dropping balls left, right, and center. And then I don't know. I think they were dealing with a bank at the time, so I told him, I said, "You got to talk to my guy here, because there's advantages."
Absolutely, yeah.
What would those advantages look like?
Well, I mean, not to disparage the banks, Kevin, but if the banking industry generally has gotten more and more inflexible over the last number of years, let's say. And if you go into the bank and you're like a marginal client, or you're a self-employed client, even a very solid business, sometimes you don't fit in the box at the bank. So in those cases, it's good to talk to a mortgage broker because we can see immediately if you're going to fit in box A, C, wherever you happen to fall, and that doesn't necessarily mean that you're not creditworthy. It just means you're in a different situation, and we need to look at alternative lenders that may not be
maybe not at the very first tier of the banks where they have those stringent regulations.
Exactly, and sometimes it doesn't have anything to do with your creditworthiness or your income. It could just mean a different set of criteria that the bank will use that, say, a credit union would not use.
Okay.
The rates could be identical, the product could be almost identical, but different ways.
Make a difference of getting the funding or not getting the funding. Or
not, correct, yeah. And again, if you go to a broker, you have a raft of different options, whereas if you go to the bank, it's this option or nothing, basically.
Right, okay, and that's therefore the box ticking. It's like, well, thank you, but no thank you.
Correct.
Yeah, I've had actually a lot of clients that have kind of talked to their bank and then they're very frustrated. Others that have dealt with their bank and they've been dealing with them for decades and they're never going to leave them and they're happy.
Right.
Here's the thing is, with the bank that I find, and nothing against banks either, but they aren't necessarily looking out for you and your best interest, where when you hire somebody that's kind of there to work for you specifically, right? The bank has thousands of clients coming at them at all times. So they're just picking the top, they're cherry picking basically.
Correct.
Is that?
That's a very appropriate way to put it, Kevin. They do have such a great volume of opportunities coming at them all the time, where if you don't quite fit in that box, they'd be happy to move on to the one that does.
Right.
Whereas a mortgage broker,
faster and easier or whatever.
Yeah, exactly. And our goal as brokers is, if you don't fit in that box at the bank, we're going to find a box that you do fit in.
Works.
And don't get me wrong, we deal with the bank. We deal with Scotiabank and TD Canada Trust and people like that all the time, every day. But sometimes the client just does not fit in those parameters for whatever reason. Or the bank doesn't have a product that the client really wants and another lender does.
Okay, that makes sense. So one of the questions I know of, a handful of the people I've worked with have asked specifically, because if you're coming in fresh, you don't know, and even if you haven't bought or sold a home in 5, 10 15 years or whatever, you probably aren't on top of it like you and me are on this every day.
Correct, yeah.
So one of the questions that I get is, so what kind of fees do I have to pay to a mortgage broker?
Okay, that's a very good question. The fees that you pay to a mortgage broker, when and if you pay a fee, are usually for very unusual circumstances. If you come to me today and you need a mortgage that can be fulfilled at a bank or a credit union, 99.9% of the time, they pay us a finder's fee for bringing your business to them.
Okay, so they're not so they don't have to necessarily pay anything extra to get your level of service.
Absolutely not. In fact, if you go to a mortgage broker, you get their expertise and some mortgage solutions, usually for absolutely no charge whatsoever.
Okay.
Again, we get paid when and if we do the mortgage for you by the lender.
Okay, so it's almost like a commission-based stuff.
It is,
except you're being paid from the bank, not the buyer.
That's correct. Yeah, the bank pays us to bring them the business.
Okay.
Yeah.
And maybe you could help me understand, or help my audience understand. I kind of understand.
Okay.
So maybe you could help my audience understand a little bit. So now here we are in a crazy marketplace. It's so hot right now. Things are flying out the door. And people are coming back and losing 1, 2, 3 times before they actually get a shot to win, or before they do win.
Right.
What are your recommendations or ideas on how to structure your offer and financing in and around that?
Okay. That brings up a really hot topic, which is an unconditional offer. I hear over and over again from clients, I'm never going to get this place if I don't go in with an unconditional offer.
Right.
And nothing against unconditional offer, except there's not a broker that I know that's keen on them.
And I would expect, just like banks, I've never talked to a banker who said, do that.
No, I mean,
you can't really say do that.
Basically, when you go in with an unconditional offer, you're giving them a deposit of $25,000 or $50,000 and saying, I don't care what this place really has going on in the background that I may not know about. Once I give you this check, I'm going to walk away from it if I decide not to go through with the deal.
Right.
And it's not maybe that simplistic, but basically that's what you're doing.
Right.
So unconditional offers, what I say to clients, there's 2 tiers of them. One would be the people that have less than 20%, where the deal has to be CMHC insured, high ratio mortgage, that's called. Those people, if they don't have a plan B in place to fall back on, if the A financing doesn't work out, they could be in big trouble and they could lose that deposit.
Right, so they could lose their money. They could potentially, because you're going in cash, like it's called the cash offer, unconditional offer, you've got no subjects and no conditions that you can step away from. So if you do and you don't get the funding and the bank says, whoops, nope, you don't quite hit that, or then you're going to have to go to alternative funding at the very best case scenario. And if that doesn't play out, then you're going to have to go to mom and dad. You're going to have to find somebody else to co-sign. You're going to have to look at these other options. Or default on the contract. And if you default, then that deposit, in the worst case scenario, is 99% of the time that deposit's completely gone. And you could even get sued for specific performance or damages.
Exactly. Absolutely. Absolutely. So that's critical to know that right up front before you make that type of offer. Then the second tier of unconditional offers would be with people with 20% or more down payment.
Right.
Those people can more easily have a plan B in place. Plan B for them would be, if the deal doesn't work out at Scotiabank at 3%, I could probably go to alternate lender at 5%.
I go to Canada Trust, I could go to RBC, but if it's Scotiabank's probably looser than RBC, but
but there's always going to be an alternate lender,
choices.
Probably at a higher rate,
right?
But you're probably not going to default on the deal.
You'll probably still be able to push it through and make it happen.
Right, but you got to be careful and you got to be prepared for that, because if I say, Kevin, your mortgage is set at 3%, and I come back and say that one's not going to work, now it's at 5%, you may not be a happy camper. So you got to know these things right up front, before you go in on the deal.
And that's why we have these conversations, is so that whoever's watching this segment, they'll know, okay, so this is some of the barriers that I've got to deal with going in. Because in today's marketplace, if you don't go unconditional for probably, I'd say 80% of the properties that are, especially the new listings coming out and they're priced well, if you don't go unconditional, you're not getting a home.
Exactly.
You're not getting a home today.
Exactly.
So you have to be prepared in advance. And so the other thing is, if you are even if you're not high ratio, it's good to have plan B in place. But if you're high ratio, so 20% or less than 20% down, I think it's critical that they have looked at what those other options are, and they've got those on lock in case the funding does not come through, or in case. So the other question, so that takes me to this other question. So pre-approvals,
Right.
how does that work?
Okay. Pre-approvals are a bit of a misnomer. There really is no such thing as a pre-approval.
Right.
There's a rate hold, and there's a potential pre-approval or conditional pre-approval.
Right.
But the conditions are the parts that will trip you up.
Yeah.
Where the condition is, what is the condition of the strata? Are there any issues with the building itself?
Right.
Is there a problem with the title? Have we got adequate proof of income in place with the lender that it really is pre-approved?
Yeah.
For instance, are your taxes paid, et cetera, et cetera.
Right.
There's so many variables in that. When the banks say you're pre-approved to go out and buy $750,000 property, you better really know what they mean by pre-approved.
Right.
Because it's really not pre-approved.
So that's a great way to say that, and I thank you for that. That's something that most people just don't know about. So what type of a question would you dig in to find out? So they've said, your bank has said, yeah, we've got a pre-approval for you. What does that mean, and what do I need to ask?
Right. Okay. Well, if you're the client and you've been to the bank and they say you're approved for X dollars in a purchase scenario, you want to ask them, am I fully approved, or is there anything else documentation-wise that you may need from me to give me that full approval? Because most of the time the bank will have you fill out a very simple application form and just do the math based on the numbers you give them.
Right.
They won't say, I need your last 2 years of tax returns,
right,
or where's your most recent pay stub, or I need a letter from your boss that says you've been employed for X years at such and such a wage, guaranteed, et cetera, et cetera, et cetera.
Right.
So unless they've done all those things, the pre-approval is no better than the piece of paper it's printed on.
That's great to know. Thank you.
Sure.
One of the things that we touched on at the beginning of our conversation was you mentioned something about, high ratio was one thing, and then you also mentioned something about people that are self-employed.
Right.
What are the barriers that people that have their own business or maybe haven't had a job for long, what are some of the things that they would have to look to or be prepared for?
Okay. Well, typically, if you're a self-employed business person, we use your last 2 most recent years of income.
Okay.
So if your income is on a increasing basis, we take the last 2 years of income, add them together, divide it by 2, and that's the income number we use for you.
Okay.
If your income's on a declining basis, we use the most recent year.
You use the lowest.
The lowest.
See, I didn't even know that.
Yeah.
Okay.
So, or we may be able to get away with an average, depending on the lender, if you've got a good reason that it dropped off in the most recent year.
Right. Like last year, we were chatting and looking around, and with COVID implications from the previous year, my business went in the tank, and so we decided to wait another year. To be honest.
Right.
Last year was a stellar year, but the year before was horrible, and they said, well,
right, and
it's not looking pretty on that.
So what we find with a lot of self-employed people, and this goes back to the banks versus other lenders, there are lenders that specifically love to deal with business for self or self-employed individuals. They do charge a little bit more. For instance, you might get a mortgage as a regular employee for 3%. A self-employed person might pay 4.5%.
Okay.
So there's a difference in the rate, but if you look at the total cost of borrowing and what you're saving as a self-employed business person by being able to write off a certain amount of costs on your tax returns, sometimes these things balance one another out.
Right.
And the main thing is you can get a mortgage where a lot of the time through a regular bank you cannot.
Gotcha. Okay. What other things do you come across? What are some interesting variables or interesting scenarios that you come across where you have to problem shoot and help the client?
Some of the more interesting ones I would say would be issues with the property itself, unusual things, and this goes back to buyer beware when you're making an unconditional offer.
Yeah.
Sometimes there'll be an issue with a building where there's been asbestos identified,
right,
and we have to send a company in there to do air tests or something like that, or there's a mold issue, or an issue will come up on on the strata documents that preclude the buyer from getting insurance on the property.
Right.
So we have relationships with insurance brokers that we can steer clients to, because sometimes their own tried and true insurance carrier won't cover that particular building or that house for some particular reason.
And that brings up another really hot topic for another segment about how the premiums are now, the insurance premiums are now a key issue for strata properties and stuff.
Right.
But one of the things that you mentioned that in like 10, 15, 20, 30 years ago when I started, the banks didn't really look at the strata documents for condos.
Correct.
It wasn't the thing. They didn't.
Right.
They just looked at the client and the building as a whole, but they didn't have reviews. Now they've got disclosures. They've got depreciation reports. Engineer studies. Anything. If there's a problem, the banks actually dig in now.
They do.
And is it the banks or is it the CMHC? Or is it both?
It's both.
Is it?
It's both, and it depends on the building. In fact, there are some buildings in Vancouver, in the greater Vancouver area, that would be what they call red flagged with certain lenders and with CMHC, where they've had a plumbing issue or they've got an electrical issue. And these don't have to be really old buildings either. They could be built within the last 10 years, and something has come up and they become known on the database within the bank or CMHC.
And you're not getting funding.
And you're not getting funding.
So it's not even you in this situation. So that's an important thing is,
yeah.
especially like in houses, that's a different story.
Right.
But for condos, it's not just you, because they realize that you're, as a purchaser of that unit, you're buying a piece of the entire project.
Right.
And so they're looking at the entire project now.
Right. Yeah.
So even if you're solid, that funding may not go through based on the project.
Exactly.
And actually, that's probably an amazing gift that a lot of people in the past didn't go through. Like back in the 80s or 90s,
Right.
They had all these before engineer studies came in and before depreciation reports were enacted.
Right.
You know, so many people had these leaky condo issues,
Right.
and they were just money out the door, right?
Correct. Yeah, and they had no way of knowing that before they went in. Exactly. Yeah.
Awesome. Well, I don't have any other questions. Is there anything? So maybe you could share your number and contact information. I'll put that in at the end of the screen as well.
Sure. Again, it's Robert Mogensen. I'm a mortgage broker in North Vancouver, and my phone number is 604-802-8193, and you can reach me at robertmogensen.com.